Hey everybody, just FYI, this could turn into three parts. I've had a lot of fun putting this one together. I guess because this is the thing that got me interested in trading in the first place. For me, it was a combination of many things, but I think the thing that kind of really always interested me is the stories of, a family member would tell me about certain things that happened in the 70s with stagflation, certain things that happened in the 80s, and the major market run that happened from 82 to 2000. The idea of moving from that point into things like microcap stocks, energy stocks, and so on, that really led the way during that time. Even banks did, and then moving later into tech again, or sorry, commodities again. Gold it was one of the main ones at that time, and then that was kind of the end of that journey for that person. People age. If I'm talking about somebody who's traded through the 50s, 60s, 70s, they're at this point they're gone, but those memories still live on. And for me, it was the idea of when everybody's very bullish on something and everybody's going tech, 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 and tech. There's two things about this. One is you never know how long that's going to run. People in that tech bubble, there's plenty of people who probably thought that was dead in 91, 92, 93, 94, 95, 96, 97. When it had the crash in a little bit of a crash in 98, it was absolutely probably dead in their eyes. And then 99 and into 2000. So two things. One is you never know how long a trend will go. You can't say that. And it's very important to understand that as a trader, especially if you're going to be a long-term trader. For me, I'm going to have trouble around certain parts of the cycle as things are shifting. I'm going to do my best trading when things are shifting into new parts of a cycle and so on. And that's what I try to be positioned in, because for me, I see that that's the best way for me to make good returns and consistent returns over and over again. And that's going to be different for everybody. But I think that the big money and like, the book in Reminiscences of a Stock Trader, Jesse Livermore, the big money is in the big swing. And those big swings are around those times. So seeing that all those things are important, I really like to look at cycles. So this process is taking a little longer than expected. The videos are going to be a little bit more than expected, but I'm having a good time. I hope everybody's enjoying it, and thank for the feedback as well. It's helping me add a couple different things to this as we go on. This is another one that's kind of this, you see these all the time, but I wanted to go to the beginning. So this is called the investment clock. This was the first thing I was ever introduced to in this. And there was older ideas like this, but nobody really made it definitive into this cycle. So when you see people like Hedgeye going, I've created this, it's not true. This has been around for a long time. I remember they were in a suit not too long ago, and I was thinking they were talking about their quad model, and I was thinking that's not a new model. And even there was basically this one started, and it's the same type of thing. There's four different parts of a cycle: inflation, recovery, they call overheating. This could be something where you have everything kind of going up at the same time, kind of the later part of a cycle. And then you have the overheating phase. Sorry, I meant to say overheating phase being that, and then the stagflation phase being what things kind of top on. And this works in different ways, and the cycle can always be shifting, and there's cycles inside of cycles and so on. But this is another one that we see a lot. But it's kind of it's easier to understand if you understand what's really going into it. All of these things are based on basically growth. You can measure that many ways. GDP, let's say, for one easy example, and then inflation, CPI and so on, core inflation, whatever metrics you want to use. Obviously, backtest these, figure out what works for you best and your time frame, and then go from there. But most importantly, they're working off the rate of change of these. This is another one. This is Ray Dalio's model. Same exact idea. then once again, this was the earliest one. This is a later one. And Dahlia's model, same exact idea. When you want to be in certain things, he has a couple other things to it. There's emerging markets on one of these things. It's also the idea that he had behind having some emerging markets, basically the all weather portfolio is what he calls it, having gold, having emerging market stocks, having developed country stocks, U.S. stocks, U.S. bonds, gold, and some commodities. And by doing all this, it kind of diversifies you across different asset classes. So when things are going well, you can make money. When things are going badly, you can make money, or at the very least, hold your money. Not lose too much in the meantime. Now this is going a little bit deeper into this. This is the Hedgeye model, same exact thing. They dissect it. Sorry, that chart's a little small. Let me see. Maybe I could blow it up a little bigger. No, I can't. Cool. Sorry, new to this website, so didn't know what I could do on it. But yeah, blowing that up a little bigger. Now we can kind of see the idea behind Goldilocks part of the cycle. Goldilocks being this, you're going to want to be tech. Basically, Goldilocks is almost everything can do very well that's growth related. Tech, and not saying growth as in growth sectors and of equities, growth as in the economy growing. We have tech, we have consumer discretionary, industrials, materials, and I think that's kind of what we're seeing leading the way right now. Are we in a Goldilocks period? I wouldn't say that. That's not exactly what I'm thinking just yet. But I could be wrong. That could be saying it, but at the moment, that's kind of what we're seeing. Money's kind of flowing into those areas. Things that are inflationary as well as defensives don't do very well in that type of environment, especially defensives. XLU, XLP, this healthcare, utilities, consumer staples. Basically, debt wise, you're going to want to be using convertible bonds, high yield debt, levered loans. Basically, these riskier debt areas usually do well around these times. And then short duration bonds, medium duration bonds don't do quite as well. Long duration bonds can hold up, but it's also kind of an area that's not what they say is not the place to be. You want to be in developed currencies like the euro and European areas and so on. Copper does well in this environment because it's growth. And then moving, let's look at the stagflation one just to kind of give it another example. You can go through all this if you'd like to. I'll put a link to this in the show notes as well. But going through, there's certain environments, and this is more where I'm thinking we're kind of at, in kind of this stagflationary type of environment, utilities, tech, energy, REITs. And you see an interesting one where tech can do well in many different environments. So, that's something you want to kind of pay attention to as well. They kind of point to that too. Long duration treasuries do very well. Munis can do well in that environment from what they say. LQD, investment grade credit, and then they're basically talking about G10 FX, once again, developed countries. Emerging market FX is a no-no in their opinion. Crude oil can go up in their opinion. So it's a very, from what they do, they kind of put it in all these different areas. From what I do, I kind of look at this and go, here's what I'm looking at. Here's a roadmap. But if the price action is telling me something different, I'm going to do what the price action is telling me. Because you can shift through all of these very easily. And if you're shifting through all these, and let's say you're here and it's saying to be long, G10 FX, and you're supposed to be long, the yen, and the yen's breaking down. You got to always remember the trends are always extremely important. You need to be in the trends of things more than anything else, because that's how we make money. It doesn't matter what's supposed to happen. So we kind of get an idea, and kind of something I always know is that it shifts between this environment, and they know this too. I'm not saying they're stupid. They know this too, and all these people talk about this. It shifts between environments. It shifts between environments, and it can shift between environments. So we see this all the time too, and it's like, yeah, that's perfect. I get the market because it's saying this, and really, it's a this is a basic diagram of what happens feelings through the market. And you really, I think the most important thing is to identify your own feelings, not this. Like, you can look at the market and think it's wherever you want to believe it is, but really, journaling, identifying your own feelings, identifying, like, were you at the euphoria point? Are you at the depression point? I've had times where and everything's going so well and too well that I should be more at this point, and then I have times where I'm depressed and I should be more at this point, really having more faith in my positions. This is the best thing you can do, is identify these times, and if you can journal, identify when you should have those feelings, what you're feeling at that time. Sometimes you can pull it out and understand where you're at in the market. Sometimes I can go to certain things, like a few years ago. If you've been in my group for a while, you do remember the November election. I've brought this up before, but during the November election, everybody was so depressed before the election, and it was miserable. I was actually sick. I actually had COVID at the time. The world felt like it was falling apart. People were talking crazy, and I got invited to the right after I got better. I got invited to something, and had to be the day before, 2 days before the election. So basically, I had COVID 2 weeks before the election. I think I got invited to this thing a day or two before the election, and we're all talking, and basically everybody's saying, like, if Biden gets elected, it's the end of the world. If Trump gets elected, it's the end of the world. There was no hope anywhere. Hedge funds were extremely short. Everybody was pretty miserable. But if you look historically, elections have a lot of optimism after it's over. It's like people go, "Oh, the election's done. I'm back with my normal life. I don't have any idea about what I was thinking 2 minutes ago." And we had a very long position at the time and a very long bias, even though the market didn't go anywhere for a long time, and it shot out of there. And so at that point, it was seeing that everybody was in this depression phase. I was also feeling that I wasn't in the same fear place, but I was in the same kind of depression state. I wasn't feeling good. I saw that everybody else is kind of feeling the same way, which kind of helped me to understand where we were at in that market. And then that helped to make it profitable. All years ending in 3, people saw when I talked about years ending in 2 on one of these. So I wanted to add this again. This is one of Larry Williams' charts from his chart book for his forecast for 2023. I used this, and I also used another thing on October bottoms in second-year elections in one of my videos as well, around the October bottom. That helped me catch the October bottom. So far, that's been the bottom. It hasn't been a great bottom because we've just kind of shaken around that area, but so far it's still holding up. We'll see if all years ending in 3 goes as well. This is kind of, once again, this is not a detrended, is kind of how you want to look at this, because we're not really looking at it and going, okay, well, the market's just going to go up all year long perfectly. It's kind of, this is a sell point. This is looked at as a buy point. This is a sell point. This is a buy point. This is a sell point. This is a buy point, and so on. And so 30 years in office. So this is another one. And this is all 3rd years in office. And then this average of all 3rd years in office, 1975 forward. And this is 1939 to 1971. Seeing 1975 forward, and it kind of looks like a normal year, but most of the time, the 3rd year in office is a very profitable year. We went over that in an earlier chart. And if that's going to be a profitable year, it's going to probably work out similar to other things, where we have a very good start to the year. Best 6 months is what they call it in seasonality. That time frame is November till April. And then we can kind of come out of that, have a kind of a choppy summer, and then end the year strong. We'll see if that holds up. I'm not sure. We have to. There's a lot of thing about seasonality, and the thing about projections and cycles like this is that you have to also understand that these things go. You can't just base everything on the cycle. You have to take the technicals into consideration. You have to take the fundamentals into consideration, sentiment into consideration. Sometimes it's a good roadmap just to know that, hey, there's a lot of activity in the market during this time. That's what that's more telling me than anything else. There's a lot of activity in the market, a lot of volume. Summers, not a lot of volume. That's just why summers can be choppy. The end of the year rally, same type of thing. A lot of optimism in the market. Next chart, Fed funds rate, the output gap. Basically, what this is looking at when we start to get over this output gap. Actually, I'll just read to you from macro ops. The zero line represents full economic capacity or a closed GDP gap. When the reading is positive above the zero line, it means the economy is producing it and above trend capacity. This causes inflation to rise and drives central banks to hike rates. This is why a recession follows after each subsequent period of above capacity production. So basically what this is telling you that as this moves up here, we start to see this kind of get to an area that the Fed starts to raise rates. Once again, Fed starts to raise rates. Once again, the Fed starts to raise rates. And has been raising rates. This is kind of another way to kind of look at some different fundamentals, but this is also used in those regime models. So we can kind of look at that in those regime models and go, okay, this is interesting, kind of a way to look at this for now. Sorry, I had some dog problems downstairs in the middle of reading that. My bad. Producer price index, PPI. This is a good way to kind of understand where inflation is heading. Most of the time, the CPI is behind it. As you see, we're moving up here. As it starts to move down, CPI moves down later. Same thing, peaks early, peaks early. I like this ratio. This is a free chart on the Fed website. Definitely check it out. And same thing here, the Fed funds rate combined with 2-year. Same thing, 2 years tops out a little bit for the Fed funds usually. This happens again and again and again. Another thing to keep an eye on, the 2-year recently kind of topped out. It had this kind of throw over reaction. That's what we call it in a Wyckoff model. Basically, it got up, it bounced above a recent high, and then threw back down right after it. Today's a Fed day, so we'll know a lot as we kind of get closer to that. S&P 500 pre-election year, and this is the cycle patterns for this year. As you're seeing, we had the big drawdown in February into March. As the banks failed, it seemed like it bottomed. So far, we're getting back up here. Will we move back into trend? Not exactly 100% sure yet, but it looks like we are at the moment. Today's Fed day, so a lot can change in the next 20 minutes. The S&P seasonality. So seasonality, once again, we talked about it before. It's not a perfect science. It's not a timing tool, but it can kind of tell us to what's historically possible. A lot of tax returns come in. Some of those go into stocks. Some of those go into the economy. Some of those go into many different things. There can be a lot of optimism around that time. Once again, April is a very bullish month. Getting back in there, see 80% of the time over the last 20 years. That's a very high probability of April being a good month. I could see April being a good month as well. Risky versus safe haven assets flows. So we're getting into sentiment again. We're seeing that there's a lot of pessimism out there. Once again, a lot of pessimism out there. And finally, we're gonna get. You know what? This is where I'm gonna stop this. We'll come in and this a little more, but this goes back with the phases. So we'll end on that. Basically, when we're looking at the phases, we're seeing phase 1. That was 2018. Same type of thing, working out of this bottom in bonds. Phase 2, working out of this kind of choppy stock area. And once again, we had that big crash that kind of happened in 2020. This is not a timing tool, but this is telling you where we're at in the cycles. And also, you'd still be long bonds if you're following this model right, because bonds being long those was through all 3 stages. So you're holding your bonds, which also gold is also a good hold during that time as well. And stage 3 is when you're going to start to buy commodities. So we'll go through where 4 through 6 and where I think we're at today in the next one. I'm going to put this out and then we'll talk soon. All right, everybody. Hope you have a good day.